All right, guys. Degen Life here. I'm going to be explaining to you guys how to dollar cost average. The reason why you guys want to get into dollar cost averaging is because this is a great way to maximize your profits while also trying to minimize your risk. So here we are. I'm on Trading View here, and I'm going to show you guys what it is that actually means to dollar cost average, how it all works, and how you guys can apply it to your trading strategies to make you more money. Of course, make sure you guys understand that when you are investing, that you are taking a risk. So make sure you guys are investing responsibly, and I'm not a financial advisor. So here we go. How the dollar cost average. This is the Google text version. Instead of investing a particular security at one time, with a single purchase, you dollar cost average. And what that means is you divide the amount of money that you have that you like to invest, and you buy small quantities over a time of regular intervals, meaning like you put a little bit in at a time instead of going all in all at once. So for instance, let's say we're looking at here, this is Bitcoin's chart. Let's say you want to invest in Bitcoin. You got $500, right? $500. And Bitcoin, would say it's right here, guys. This was when Bitcoin was at 69,000. This is the all-time high. Bitcoin has never been higher than this. It's the highest it's ever been. Well, a lot of times people end up buying the top. This is when everybody in the world, November 12th, that day, everybody thought Bitcoin was going to go to the moon. Everyone thought it was going to go to 100,000. So people are buying up. You got your $500. You're like, I'm buying $500 worth of Bitcoin. You bought it. You bought it at 69K, and you held it and you watch. You watch it, and you saw your $500 of Bitcoin go down in value over a period of 6 to 8 months, and is now trading at 23,000. In fact, let's draw a chart here. Oh, I'm using the wrong one here. Let's see how much you actually would be down if you would have bought the top here. And we scroll all the way down to where it's at right now. It's around 24,000. You're down 65%, guys. 65% of $500. You would have $175 left right now. You would have lost $325 if you would have just put your $500 and bought Bitcoin at this level here. Now, what I'm about to tell you is what it's called dollar cost averaging. I'm going to explain to you why dollar cost averaging would have been a much better play in this situation than versus just going all in with 500, making one initial investment. Now, let's say, let me check here. We clear this out. Now, let's say instead of doing $500, you bought $100 up here. So you bought $100 here, and then you decide to buy another $100 here at, let's say, 50,000, and then you bought another $100 at 40,000. Then you bought another $100 at 25,000, and then you bought $100 at when it went too close to the bottom at 18,000. Okay, so you had you still put in the same amount of money. You put in $500. But you broke it up and you bought it at different price levels. In fact, you bought it lower than what you initially put it up. Well, guess what? Your average, adding all of those together, that $500 average, your average investment probably would be around in the $40,000 range. Maybe even lower. Maybe it'd be like $30,000 to $40,000. So that would be where you could start earning money. Like this is where, like, that's your point. Like, that is where you have initially has made your investment is average in, where if you would have made one investment at 500 at the top at 69K, then your average would be 69K. But if you bought 100 there, you bought 100 down here, 100 down there, then your average is going to be lower. So that way it's going to take less amount of momentum or less amount of time and a less amount of gains for you to start making profits versus up here. Because it would say you bought up here, prices down here. Well, guess what? You might have to wait a long time, and you're going to have to see a huge amount of gains before it gets back up to these price levels where you actually could start making money, because you're down right now. Right now you're losing money until it goes above your initial target point. Now when you broke it up, now that initial target point is down here, so it doesn't have to go up as high before you start making money. And that is dollar cost averaging. So let's say your dollar cost averaging, you put in 100 here, 100 here, 100 here, 100 there, and let's say your average is 40,000, and we do the same thing again to where it is now at 24K. Or let's say it's a rough estimate. Now you're only down 40% versus the 65% that you're down, just going all in 500 at the top. You're now only down 40%, which is, actually at $300 is what your value is versus $175, and you're only down $200 instead of $325. And like I said, there's a lot less time and gains for you have to before you start making money again. So that is what dollar cost averaging is definitely a very good strategy. I personally do the dollar cost averaging strategy, and if you liked this strategy, make sure to like and subscribe and follow for more, because I'm going to be showing you guys my plays here in the future, trading in stocks and trading in cryptos, and you guys are going to see me doing a lot of dollar cost averaging and holding on for the next bull run cycle, so that way I can make profits when I'm trading. If you like this, make sure to like and subscribe. See you guys on the next one. Adios.